Mayra Rodriguez Valladares, Managing Principal at MRV Associates, joining us now. Can I just take a step back, Mayra, and talk a little bit about what is happening big picture here? Central banks, the Fed, the ECB, other central banks around the world, concerns about the climate risk that exists within credit markets, within financial markets. How exposed is the financial sector to climate risk? And do you think the market really understands yet the risk that poses?
The financial sector is incredibly exposed to climate risk, especially from the physical and the transitional aspects. Unfortunately, there aren't set standards either by the Securities and Exchange Commission here in the U.S. or by bank regulators. And the exposures are both from a credit perspective. Banks lend to a lot of companies and individuals in about 20 states here in the U.S. that are extremely exposed to climate change. And the banks are also very, very exposed to market risk, because when you have these big natural disasters like with Hurricane Ida right now, recently, it also really impacts bond and stock prices. So a lot of people haven't really tuned into these kinds of risks, and it does really affect not only the banks, but also different kinds of asset managers like pension funds and insurance companies.
Can we talk about the need for perhaps maybe more clear guidance on what constitutes a green bond or not? I know in the past, for example, if I've covered muni bonds, the bonds are for education or water and sewer. And so people say, oh, there, it's a green bond. But is it? I mean, do we need more strict guidelines on really what is a green bond and what is not, so that you don't just slap that label on for a good look?
That's an excellent point. A critical actor here are the rating agencies. So your global rating agencies like Moody's, Fitch, S&P really do need to also have more supervision. They need to be more accountable, because they're the ones that really are establishing an ESG assessment. It's not a rating, and that needs to be clear. And so there need to be standards from the exchange commissions. In our case here in the U.S., it would be the SEC, but to really establish what exactly does a company need to meet. And there are no standards at the moment in the US. And so what is green, or what is social, or what is governance? There aren't those standards. So you need standards from the SEC, and then they need to be abided by the rating agencies. And so that's why you have a situation where companies can issue, they can call a bond green, but you don't have set standards. And we're definitely behind Europe in setting these kinds of standards. And we run the risk, investors really run the risk that they're buying what they think is a green bond, and next thing you know, they have a massive problem.
Okay, so let's talk about that relationship between Europe and the United States. We've just seen yesterday a huge amount of demand for a Spanish green bond, a govie bond. People are paying a premium over a traditional govie bond. We were about to see Germany doing the same thing. I suspect you're going to get a similar premium. We probably need more issuance to close that gap. But is Europe going to set the standard here? Is Europe so far out in front at the moment that it is going to set the rules?
That's an interesting point. Europe at the moment is quite ahead when it comes to setting standards, both for companies in terms of what is green. It's also ahead of the United States in terms of requiring stress tests related to climate change for the banks. However, a lot of the financial institutions in Europe do have specific problems still lingering from the Eurozone crisis. So I would be a little bit careful about saying, is the U.S. financial sector, for example, going to be left behind forever? However, what we need here is accountability and leadership from the bank regulators, the Fed, FDIC, and OCC, and we need leadership from the SEC. The Commodities Futures Trading Commission has actually done a brilliant job in trying to work now with climate change, but it is only the regulator for a big part of the derivatives market, but not for the requirements that companies have to make it clear whether their bonds are really green. That really does lie with the SEC. The bank regulators can certainly make requirements of the banks for the level of capital and liquidity, for example. They should be allocating for these green bonds in case that they don't turn out to be as green as is promised. It could really cause a lot of credit and market risks for the banks.
Are the returns there for investors?
Yes, I think they can be. The returns can be there when the markets can really trust the information that they're getting there. And the reason right now there's so much demand for these green bonds, I would conjecture to say that it's not so much that there's this vast interest, unfortunately, in true ESG implementation. It's just the fact that, unfortunately, companies are still very much in a yield chasing mode. We've now been in over 2 decades of low interest rates. Certainly the last year, there's been even more cuts. And so this incredible hunger for yield is also what's fueling this market. It's not just that people have a strong interest in ESG.